This conference will now be recorded.
All right. So tonight we're going to talk about homeowners versus business owners. On the personal line side, we have the homeowners policies. There's different types we'll get into, and then there's the business owner policy. So I'll go through the homeowners first, then we'll go through the business owners, and then we'll do a quick side-by-side comparison so you can understand it. They're very similar, okay? And like I said, we'll go over it. So, all right. In order to buy a homeowner's policy, the home must be what we call owner-occupied. You own it, you live in it. With a homeowner's policy, you can cover up to 2 family living units. That means a single-family home for an individual, right, or their family, or a duplex, right? So 1 to 2 family living units. Like you own a house, it's a duplex, you live in one unit, you rent out the other. You can still cover it under a homeowner's policy as long as you live there, and it's no more than 2 units. If it's more than 2 units, like 3 units or a 4-unit structure, then you're going to have to go to a dwelling policy. If it's larger than 4 family living units, like a fourplex, then you're going to go to a business owner policy. Okay. The homeowner's policy is a package policy. It covers property, theft, and liability all bundled up. All right. So, being that it's a multi-line policy, it does cover the property, right? Section 1 is property. Coverage A is dwelling. B is any other structures on the premises. That would be like a fence, a pool house, a separate garage. Coverage C is your personal property, which, by the way, is covered anywhere in the world. That's kind of nice, right? So even though you bought a little home policy here in wherever you're living at, and you go take a vacation and you take some stuff with you, and while you're out having dinner at a restaurant, someone breaks into your hotel room and steals your stuff, it's covered under your homeowner's policy that you bought here. So A, B, and C are direct loss coverages. Direct physical loss, damage, or destruction of your property. That's how you want to understand that. Coverage D is loss of use, and this is an indirect loss coverage. So if the house burns down, you cannot stay there. It's uninhabitable. Then loss of use coverage would cover the cost to pay for you to stay at a hotel till they rebuilt your house, and then you can move back in after it's rebuilt. So it's kind of indirect, or a lot of times you'll see it as consequential loss coverage on your test. Theft is also included. It's another line of coverage, but it is built into this policy. Theft of your personal property anywhere in the world. There are sublimits, right? Just keep that in mind. Remember, theft of jewelry has a $1,500 sublimit. That means even though you have, let's say, $200,000 of personal property coverage, if someone steals your jewelry, the maximum you'll get is at $1,500. And so you might want to consider getting a floater, jewelry floater, jewelry coverage, increase the limits of jewelry, so then if someone steals it, you get the replacement value for the jewelry. Another type of sublimit related to theft would be theft of firearms, $2,500, silverware, $2,500. Trailers used with watercraft, or if you have a trailer that's not used with a watercraft, $1,500. And so there's a couple sublimits on certain types of losses, and those are the main ones that you might see on the test. But all of those little sublimit items, you can buy a floater, which is a type of inland marine coverage. Even though it's called floater or inland marine coverage, it has nothing to do with boats. You can buy a floater to increase the coverage on those high theft items, so you actually can get replacement cost for them. It's an all-risk coverage, worldwide coverage, so it's a lot better. If you want, you got some high theft items, high ticket value items, and you definitely want to increase the coverage and get a floater on that. You can actually purchase floaters on all of your high theft items. The exception is cash. The maximum your policy will pay for cash is $200. Whether someone breaks in your house and steals it, or you said, you had $50,000 in the mattress and it got destroyed by the fire, all you will get is $200. Okay, and you cannot get a floater for that on the test. In the real world, some of your companies for additional premium can actually give you higher limits of coverage for cash. All right. Now I'm talking regular cash too. I'm not talking about stamp and coin collections. Right, so that's a different world. So Section 1 is property, includes theft. Section 2 is liability, and the liability is personal liability, which covers you and your family members anywhere in the world. So if you're on vacation in Europe and you're on a golf course and you shank a ball and hit someone in the head, this little policy that you bought here in your neighborhood covers that lawsuit because you injured some other party in another country. All right, so that personal liability covers you and your family members anywhere in the world. The exclusion or exception is it does not cover intentional acts. Insurance never covers intentional acts, so keep that in mind. Medical coverage, medical is only maybe 1,000, 2,000. Some people get 5,000, maybe 10,000. Medical is just covering the ambulance ride. You know, you have a pool party, someone slips by the edge of the pool and hits their head on the ground. Medical will cover the ambulance ride. And since they're in the hospital racking up medical bills and they're not able to work, the personal liability will actually cover that. Medical bills and lost wages, right, due to the injury. So that's kind of the breakdown of coverages on the homeowner's policy. We have different types of homeowners policies, right? But we'll go into a little more detail on the breakdown here. So Section 1 is property. I said coverage A is a dwelling, which is the house. As you can see in the background here, anything bolted, welded, nailed, attached to that structure is coverage A. Coverage B is other structures on the premises. Right? You kind of see it shaded, but there's a fence over here. This particular garage is attached to the house, so the garage would actually be part of coverage A. But if the garage was separate from the house, there was a clearing between the house and the garage, maybe just a utility line connecting the two buildings, then the garage would be coverage B, an other structure. Right? And the standard limit for other structures, and you do need to know these percentages, is 10% of coverage A. All right, so everything's based on coverage A. So if it costs $400,000 to rebuild this house, we're going to give you 10% of that $400,000, which is $40,000. That's how much we're going to give you to repair or rebuild your other structures if they suffer loss. Coverage C is personal property. Like I said, if you flip your house upside down, anything that falls would be personal property. Personal property is covered anywhere in the world. The limit is 50% of coverage A. So again, if it costs $400,000 to rebuild this house, you're going to get up to 50% of coverage A. That means $200,000 can be used up to $200,000 to cover your belongings that were destroyed by a covered peril. So recapping up to this point, coverage A pays $400,000 plus other structures 10%, which is another $40,000, plus 50%, which is another $200,000 to replace your belongings. Right? That's how that works. So it's not $400,000, and out of the $400,000, 10% goes to other structures, 50% goes to personal property, which leaves less than $200,000 to rebuild a house. That's not how it works. It's the $400,000 plus the $40,000 plus the $200,000. Okay, that's how you want to calculate that. All right. All of these, like I said, are direct loss coverages. Coverage A and B are what we call real property, which are structures on the premises. And personal property, a lot of times, is called contents coverage, personal belongings, stuff that's easily movable. Like a ceiling fan, that would be part of the structure. Even though you move, you might want to take it. It's still bolted, welded, attached to the structure. We would rate that as part of the structure. Coverage D, like I said, is loss of use, putting you up at a hotel. If we need to rebuild your house and you can't be there because it's uninhabitable, we give you 20% of coverage A. So again, if coverage A is I'm jumping ahead. If coverage A is $400,000 to rebuild a house, you get up to $80,000 to put yourself up in a hotel. And that's kind of how you want to know that. You need to know these limits, like I said. The most common one out of these three is the other structures at 10% limit. That's a very common test question. As far as loss of use, it's broken down into two subcategories. I should put D1 and D2. D1 is additional living expenses, which is putting you up at a hotel. D2 would be lost rents. Like, let's say you rented out a room to help make ends meet, and the place burns down where the renter has to relocate because the place is now untenable. All right, this can pay you lost rents that they would have normally paid. In a dwelling policy, you have 5 coverage parts under property. Homeowners, they just package it up in the four, A, B, C, D. Loss of use is taking coverage D and E from a dwelling policy and combining it and calling it loss of use. But it's really the same thing. Theft coverage, we already talked about the sublimits. These are the ones you need to know. Again, you can buy floaters and you can increase the coverage on these items except for the money, the cash. $200 maximum is all you'll get. Section 2 is liability, and the standard limit is $100,000. You can always buy more. The standard limit for medical is $1,000. You can always increase that also. Now, this $100,000 is per occurrence. So if you had one slip and fall by the pool, we'll pay up to $100,000 for that particular incident. But then your policy has an aggregate limit. And an aggregate limit is the maximum your policy will pay for all of your claims during that policy period. And so for liability, if you got a $100,000 per occurrence limit, a lot of times the aggregate limit will be double that, so you get $200,000. That means you could have a bunch of small claims as long as it does not exceed $200,000 during that policy period. If the losses or claims exceed the $200,000 aggregate limit, then once we, the company, paid up to $200,000 for liability losses, we're done. The rest is on you. Okay, you've exceeded your policy limits. That's how you want to know that. Right? So per occurrence up to the aggregate limit. The different homeowners policies, we have HO1 through HO8. There's no such thing as HO7. And even on the test, most states, HO1 isn't even sold anymore, but that would be the basic. So your cause of loss forms are basic, broad, special. Basic and broad are named peril forms. Basic is very limited. Broad covers just more limited perils, but they're still named peril policies. HO3 is a special form, so we now transition from a named peril program to all risk. All risk is actually pretty comprehensive. How your test tricks you is you've got an HO1, HO2, or HO3. Which of the following has the broadest coverage? And when you hear broadest coverage, a lot of people focus on, well, HO2 is a broad form, so that's got to be the one with the broadest coverage. And that would be incorrect. HO3 is a special form, and HO3 has the broadest coverage. Right? We cover anything you could possibly think of that damages your property, except for this small list of exclusions. That's how you want to understand it. So HO1 is good for a home policy. HO2 is better, but HO3 is the best. I mean, that's typically how you would look at it. But since HO1 is not sold in most states, HO2 is good, HO3 special is better, but HO5 is the best if you own a home. For the test, there is no such thing as a renter's policy. It is a homeowner's policy designed to cover someone who rents. We're going to call it a homeowner's policy HO4. All right, so there's no renter's policy on the test. It's an HO4 or a homeowner's policy designed for a renter called an HO4. There's no such thing as a condo policy. Again, it is a homeowner's policy designed for someone who owns a condo called an HO6. Now, in the real world, we talk like that. Let's get you some renter's coverage. Let's get you a condo policy. But on the test, no. Okay? You need to know that if someone's renting, they need an HO4. Or if someone owns a condo, they need an HO6. Okay? That's how you want to understand that. HO8 is for antique or older homes. I call them century homes, right? HO8 is kind of like a modified HO1. It's a basic form. It's quite limited. And it's going to pay actual cash value for that antique home you have. See, if an antique home burns down, we can rebuild it to look kind of like it did before the fire, but it's no longer an antique. So rather than give you reconstruction costs or replacement costs, we're just going to pay actual cash value. What does it cost to rebuild it minus depreciation? That's what we're going to do. So that's an HO8. So with HO1 basic, and I got to be honest with you, all of our homeowners policies are structured pretty much the same. Okay, Section 1 is property, Section 2 is liability. The liability portion on every policy is the same. 100,000 for liability, 1,000 for medical. You can always get higher limits, but all of our policy, what all of your home policies have in common is the personal liability and medical is the same on all of them. So knowing that, the difference is between the homeowners policies, the property section. So with an HO1, its actual cash value and everything, its basic form perils is very limited. HO2 is better. We're going to give you replacement costs on the buildings. That means replace it, rebuild it brand new without deduction for depreciation. But we're going to give you actual cash value for your personal property. Whenever you see actual cash value, think of we're going to give you the used value of your property. So if you had a 50-inch big screen and burned up in the fire, we're going to depreciate it. And so when we pay you out on that for that TV, you can afford a 13-inch black and white diagonal because that's what actual cash value is. And it's a very limited policy because it's broad form coverage also here. Again, the liability coverages and medical is the same. HO3 is the special form, still replacement cost on the dwelling and other structures, actual cash value on contents. HO3 gives you all risk coverage on the buildings, but you still have the broad form or named peril coverage on your contents. Okay. So that's where it's different from the HO2. So HO2, you have broad form coverage on the structure, broad form coverage on contents. HO3 is better because we're giving you the all risk great coverage on the structures, but you still have that broad form coverage on your contents. Okay. HO4, right, that's that renter's policy, all right, or I should say a homeowner's policy for a renter. There is no structures coverage. See, if you're renting an apartment, you don't own the building. You're just covering your belongings in someone else's building, right? You do have loss of use coverage, so if the place burns down, you have money to stay at a hotel until they rebuild. But if it's going to take too long, take that loss of use money and put a deposit and go live somewhere else. Right, but at least you have options, even with an HO4 policy. And again, the liability coverages are the same. Right? Just because you're renting doesn't mean you have less to sue for than someone who owns a home. And so the liability coverages are the same on all of our policies. It's based on the limits you chose. HO5 is the better homeowner's policy. And I'll recap this real quick when we get to that screen. It's like an HO3, replacement costs on the structures, actual cash value on your contents. The difference between HO3 and HO5 is HO5 now gives you all risk coverage on your contents also. So all risk coverage, which is a great coverage on the structures, and now you have that great coverage on your contents also. So it's a little better. All right? So remember, if you own a home, HO2 is good, HO3 is better, but HO5 would be the best. HO2 is a broad form, so it's named peril coverage on your structures and contents. HO3 is better. It gives you all risk coverage on the structures, but you still got that broad form coverage on your contents. And that's why HO5 is the best, because we're giving you all risk coverage on the structures and all risk coverage on your contents. Every once in a while on the test, you might see an HO3 plus an HO15 endorsement. If you see HO3 plus HO15, that actually equals an HO5. Right? That's the new math, right? HO3 plus HO15 equals HO5. Okay, so you might see it as an HO5, or you might see it as HO3 with an HO15 endorsement. It's the same thing. Again, another way to try and confuse you, to kind of test yourself, challenge yourself, stress yourself out, and cause you to fail, so they get a retest fee. Yeah, the test is tricky, folks. And this is like a new language for you guys. You guys aren't used to like looking at something and breaking it down. You say, yeah, my friend lives in that house over there. That's about it. You don't dissect it. What type of roof is it? Are there any other structures in the back? But if you do, get one of the homeowner sheet from my website. Pick a tablet out there, I guess, if it's on there, and just take a look at the coverage breakdowns and hold it up to the house next door across the street. Coverage A is the house, right? That means just anything bolted, welded, nailed, attached to this, that's coverage A. Coverage B is a separate structure like the fence, right? Maybe a pool or pool house. Coverage C is all their contents. If the house burns down, coverage D, loss of use, helps put them up in a hotel until they rebuild it, and then they can move back in. Okay, that's kind of what indemnity is all about. All right, so HO6 is a homeowner's policy designed for someone who owns a condo. Now, as far as condo, there is limited coverage for the dwelling. Okay, so let's say you own the condo over here. Okay, you don't own the building. That's the condominium association, right? But you own this interior unit, and you own the walls, the interior walls. You own the kitchen cabinets, and you own the bathtub. And so that's why there's some limited coverage for the dwelling, because it covers those things. You really don't have any other structures, okay? I mean, over here, they're parking out front. There's not even a carport. If there was a carport, it's common grounds is typically covered by the condominium association program, right? And you're going to pay condominium association dues to support that policy. But you could add other structures coverage if you were responsible for a garage or maybe a storage unit. Then you could increase coverage for that. But in general, no, it doesn't cover that. Still covers your personal property anywhere in the world, right? And still provides loss of use. If the apartment building burns down or the condo building burns down, covers costs, put you up in a hotel until they rebuild it and you can move back in. All right. HO8, like I said, antiques, older homes, right? Very limited actual cash value, basic form peril. So it's very, very limited for older homes. To be honest with you, there's a sublimit of $1,000 for any type of theft loss. Okay, so it's very limited policy, but it's for older homes. If you own a mobile home, you can cover it through an HO2 or HO3. You will have to get an MH200 endorsement, which this is the mobile home endorsement. Right? In order to be covered as a mobile home, it's got to be at least 10 feet by 40 feet, which is a single wide, and it's got to be worth at least $4,000 to be covered. Okay, you cannot cover a mobile home with an HO5. Right? The difference between mobile home and a manufactured home is the year that it was built. I believe 1972 is the cutoff. If it was built before 1972, it's a mobile home. If it was built after 1972, then it's a manufactured home. Okay. I don't think they'll get that detailed on the test, but when you're dealing with the public and selling these types of policies, that's some good knowledge. Okay. All right. If you do own a condo, you can actually get an HO4 or an HO6. Right? Sometimes the condominium association policy has really good coverage, usually when it's brand new. It's going to have the association's coverage, which is going to cover the exteriors and common grounds, stairways and hallways in the building. And then it's going to cover unit owner's coverage. Now, the unit owner's coverage can actually cover your interior walls, your kitchen cabinets, and your bathtub. And so if your association policy has both exterior and interior coverage, you just need an HO4. Okay. But after a while, you're tired of paying association dues. You want to lower your costs, and so eventually they'll drop the unit owner's coverage and make you responsible for your interior walls, kitchen cabinets, and bathtub, and that's when you rotate over to an HO6. Okay, so please keep in mind HO4 or HO6 may be used for someone who owns a condo. All right. Some other items, building ordinance or code, this is usually excluded from coverage. You know, the building codes have changed. If your house was built in the 70s, it probably didn't have a sprinkler system. But if you were to have a fire and they got to rebuild it today, the building codes require at least a partial sprinkler system. Right? Well, the insurance company isn't going to pay for it because that kind of is outside the lines of what the definition of indemnity is. Indemnity means restore you to what you had or the condition that you had prior to a loss. Well, you didn't have sprinklers before the fire. Why are we, the insurance company, paying for your sprinklers after the fire? And so building ordinance is usually excluded from your policies. But a lot of your homeowners policies typically provide at least 10% of coverage for the building ordinance. So that $400,000 to rebuild the house, we can give you another additional 10%, another $40,000 to cover any increased costs of construction due to the changes in building codes or building ordinances. Okay, it can be applied towards that sprinkler system that you didn't have before the fire, but you now have to have after the fire during your rebuild. All right. If you are part of a homeowners, townhome, or condominium association, your standard policy gives you $1,000 for loss assessment. Okay, so you can always, increase that. There's an endorsement to increase coverage for loss assessment. We just had a customer within this past year got a $70,000 loss assessment. And on their policy, because they had the basic one that they didn't talk to their agent about, or the agent didn't present to them, which only paid $1,000 towards that $70,000 loss assessment. So they actually had to pay $69,000 out of their back pocket because of that situation. So always recommend higher loss assessment coverage. I'm giving you some real-world marketing sales tips, just so you know. So probably not on the test. The test will say, what is the limit for loss assessment? And you want to look for $1,000. Removal versus debris removal. These are two different things. Debris removal is probably the more common one. That's cleanup after a loss. Volcano erupts several miles away, but it dumps a bunch of ash on your house, and now you got to clean that up. Well, that's debris removal, cleanup after a loss. Right. Removal is your house is on fire. Well, first thing you do, you usually get out with your family. Right. Then you call the authorities, 911, and then you may run inside the house and take some of your personal property and move it out to your driveway to protect it from the fire. And this is called removal. Now, your property during removal is covered on an all-risk basis. It doesn't matter what type of policy you have, whether it's basic, broad, named peril, right? It still covers removal of your personal property on an all-risk basis during a period of removal. And your homeowner's policies will provide full all-risk coverage on your contents for up to 30 days while it's at another location. Okay. So that means, you're taking the stuff out of your house, putting it in your neighbor's yard or your front yard, and you run back in to grab more stuff. And when you come out, people are stealing your stuff because you're just giving it to them. Theft, the unavoidable theft during removal is covered because during removal, like I said, it's all risk. Where this may also come into play that people don't realize is, let's say you're moving from one house to another house, and you're transitioning your personal property from this location to this other location, and you have to take several trips with the truck. The property will be covered at both locations for up to 30 days because of this removal condition. Okay. Workers' compensation, depending on the state you're in. Here in California, it's on the test, by the way. Workers' compensation is a mandatory endorsement. So if you have a home office and you provide a service out of your home, this can typically cover up to 2 employees, they say, but you want to make sure that the business is listed under the home policy. And I don't like that that's presented that way because realistically, workers' compensation covers you have a live-in maid or butler, and their job is to upkeep the premises or the property. And if they're injured in the course of upkeeping the property, that's a workers' compensation claim. Right? And that's where the workers' compensation is typically used. Right. As far as a business, please keep in mind that your homeowner's policy and your dwelling policy can cover you providing a service out of your house. Maybe you have a home office where you cut hair. Maybe you do real estate transactions. That's okay. Maybe you do taxes. That's a service. And we can add it to your home policy to, increase the liability associated with that particular type of business. But if you're doing retail sales, so you have a little shop and you manufacture stuff, or maybe you do some woodworking and you sell it to the public, that type of business will not be covered because there's inventory there, which is increased risk. There's a lot more foot traffic, which increases the liability exposure there also because of that situation. And so retail sales is not going to be covered on your homeowner's policy, but a retail service could be. Right, and that's how you want to understand that part. Okay. So remember, keep in mind, homeowner's policy is a self-contained package policy, covers property, theft, and liability. It's got to be owner-occupied, and it's, again, 1 to 2 family living units. If it's larger than that, then you're going to have to go to dwelling up to 4 units. A business owner policy up to 6 stories. If it's larger than that, then you're going to commercial coverage. Okay. So with that, let's see, I'm going to pause here. Does anyone have any questions at this point in time on that section?
No, I don't.
No, not at all.
All right.
I do have some questions,
Ask away.
but they're not regarding the one you just explained right now. It's on a different subject, so I don't know if fine, I can ask you right now.
Throw it out there. Come on. That's all right.
Okay, so I was reading about negligence, and I'm kind of confused because there's one that you have to. So it's if it is comparative, you don't have to pay, but then the other one you have to. And how does determine
No.
it? Like, oh, it is. What type of negligence?
Contributory. It's contributory versus comparative.
So
Okay.
I know the comparative you don't have to pay, but how is that determined? Like the companies decide that, or oh, you're 40%
No, you.
in.
Oh yeah, no, that's going to be the claims determining that. So let's say,
Okay.
I mean, this happens quite a bit. You go shopping, right? You go to the mall, okay? And you're backing out of the parking lot, and someone behind you is backing out at the same time you are, and you bump each other. Okay, since you both contributed to the loss, if you see contributory negligence, since both of you contributed to the loss, neither one of you will be covered by your insurance.
Okay.
Okay, so you cannot go after them, they cannot go after you. You guys basically pay for your own damage by yourself. Okay. Comparative negligence, one will be 51% at fault, the other one's 49% at fault, and their insurance companies will basically pay out based on that. So if you're 49% responsible, you'll collect 51% from the other party, and they're going to collect 49% from your company. Okay? Does that make sense? So when you see comparative, compare means we share the claim. Okay?
And how about if it is?
Go ahead.
Yeah, go ahead.
Oh,
No,
go
my
ahead. Go ahead.
question was, okay, so how about if it is like, okay, so it's negligence but comparative, and then let's see, I have this accident that is I'm 60% and the other person is 40%. So if it is like that big difference, my company doesn't have to pay this other person, even though I have like 60% and the other person has 40%.
Under comparative negligence, they will share the claim. Each company pays for their responsible party's damages. If it's contributory negligence, if it's a 60-40 injury, 60-40 loss, none of them collect from the other party.
Doesn't matter the
Okay.
difference of, like if it is
Doesn't
like
matter.
60. Okay.
Doesn't matter. So again, as you can see on the screen here, contributory negligence, if you contribute in any way, shape, or form, you get nothing from the other party.
Okay.
So, but
So
comparative negligence, this is where you share it. The claims are shared.
Okay.
So if you're 25% responsible, you can still collect the other 75%. Okay? So remember, compare means we share, and contributory means you get nothing.
Okay.
Most states, we don't have contributory negligence. Most states do follow comparative negligence rules.
Mm-hmm.
Okay? But that's how you want to know that. Okay?
Okay, then.
Now, all of
I
this,
guess
if you're
something
online,
should be in the test.
what's that?
Since we're in California, this still will come out in the test, right?
Yeah, you'll get actually 3 to 5 questions just on these 2 topics right here.
Okay.
Okay.
And I have another question.
Hold on, let me back up. So negligence, you got to look at the definition of negligence here. Okay. So when you say negligence, I mean, yeah, we have different types, but make sure you know the definition of negligence. Okay. And then for losses due to negligence, there's different types of payouts, and this is kind of how you want to view that. So this is in the playbook that's on my website. So right after the sample test questions, the next section is the playbook, and that's basically what this is. And so it's going to give you a lot of definitions and understanding that you want to definitely study. Okay?
Okay.
All right. What's your other question, Jocelyn?
So I was reading about the two way to write a CGL, and it was about like you can have a retroactive date, and you can go back to 5 years and you will be covered. How did that work? Because I was not quite sure, like how a company will cover you 5 years. Like, you know, let's see if you just bought it in 2021, but it can cover you from 2016 to present. But like I didn't understand that
No,
part.
it's not quite that way. Okay, so there's two ways of writing commercial general liability here on the left side: occurrence-made coverage and claims-made coverage. Okay, so occurrence-made coverage is like auto insurance. If you have an accident today, tomorrow your policy renews, and let's say either you renew with the same company, it's a new policy because it's a new policy period, or maybe you bought a policy with another company. And then on Monday, you actually go in and file your claim. So when you're filing your claim, actually the new policy is in force. But under occurrence-made coverage, we're going to go back in time to the policy that was in effect today when you had your accident is going to pay for your accident even though you filed your claim in the future. That's how occurrence-made coverage works. Claims-made coverage is like health insurance. You know, maybe you hurt your back a couple of years ago and, you know, you walk it off, you're doing stretches and you're feeling pretty good, you know, and you run out, you buy a health insurance policy today, and after a couple months, your back's kind of bothering you again, and you go to the doctors and they say, hey, you need surgery. And so you file a claim with your health insurance company, and even though that bad back initially happened 5 years ago, you're filing a claim today, we're going to go ahead and cover it with this policy that's in force today when you're filing the claim. Okay.
Okay. Now I understand what it means.
So, and I got to change this. Auto insurance should be up here. Medical insurance should be down here. I got to change this. I apologize. Yeah. Okay. So now, once you file a claim under a claims-made policy, the mini tail kicks in. Okay. All right. So if you filed a claim during the policy period within 60 days after coverage ends for something that happened during the policy period, we're going to cover it. Okay. In fact, when you file a claim, we now cover your medical for 5 years. So if you slipped and fell during the policy period, you filed a claim, we're going to now cover your medical for up to 5 years. Okay. That's what the tail is. At the end of the policy, we still carry the claim. Okay. Now, if you don't go to the doctor for within a 5 year period, the claim is closed. Okay.
Okay.
So, and that's how that works. Okay.
Okay. So I think that's it. Well, just another question. Yeah, because I've been like studying like this past days because I almost had my test, so I just want to be sure. I have just one more question. So we were talking about like the homeowners policies and all that. So I know to buy like an HO2, HO3, HO5, you must be the homeowner, right? You have to be the owner of the house. Okay.
You own the home and you live in it. Yes.
Okay then. And how about the DP? So DP is for a person who's renting a house, or let's say I own a house and I'm gonna rent it to someone else, so I'm gonna get
you're
a
a
DP
landlord.
then. Okay.
Yeah. Dwelling is more for you own the property, you're a landlord.
Okay. So that's where it goes the DPs then, the DP1 and DP2 and DP3.
You got it.
So yeah, that was my last question. Thank you so much for helping
no worries.
me.
No worries.
Yeah, like I'm learning so much with you than I learned with this others when I took the hours that I need to for by law. I think it was 40, 50 hours. So yeah, like
who did you use for your 52 hours?
AD Banker.
AD Banker? Okay, stop
Yes.
using them. If you want to pass this test, just listen to me. Only study
Okay.
my material. Okay?
Yeah,
I
that's what
can't
I've been
vouch for
doing.
any banker. Only study my stuff. Okay?
Okay.
You got it. I
Okay.
know my stuff works. Okay? Because
Yeah.
I get it. Yeah. I got another really cool message the other day too. Oh my God, you guys are awesome. So it's kind of neat. All right, cool. All right, let's roll into business owner coverage. All right, a business owner policy is similar in design to a homeowner's policy. All right, very similar. When you hear a business owner policy, I mean, think of mom and pop shops. So let me get you up there. So remember, a BOP is for no more than 6 stories. So remember, homeowners is 1 to 2 units. Dwelling is 1 to 4, right? If it's more than 4, you go to a business owner policy or a BOP, a BOP, right? And this covers up to 6 stories high. It cannot be larger than 6 stories, so a 7-story building would not qualify. No more than 100,000 square feet in size. So if it's 5 stories, but it's 200,000 square feet, that's too large for a business owner policy. If you do more than $3 million in annual sales, you're too large for a business owner policy. So like I said, think of this as for a mom and pop general store. If it's too specialized, you're going to go to commercial, like an auto repair facility. That's too specialized. You're going to go to commercial auto coverage for that. Okay. Now, a business owner policy may cover restaurants, but for the test, as long as they don't serve alcohol. If they serve alcohol for the test, you're going to go to a commercial policy. And you're going to have to get that liquor liability endorsement added to your commercial general liability policy. Okay. So if you see multiplex cinemas, they're not covered here. Multiplex movie theaters, they do more than $3 million a year. Financial institutions like banks, credit unions, savings and loans, they do more than $3 million a year. They are not allowable or acceptable for a business owner policy. Okay. Those are some of the things you want to know. I've seen a carnival. A carnival cannot be covered by a BOP because it's just too much increased risk to be covered by a business owner policy. Okay. Some items to know: on all of your property policies, the standard deductible is $250. Whether it's auto, dwelling, or home, even commercial property coverage, the standard deductible is $250. But for a business owner policy, the standard deductible is $500. Again, you can raise it if you want to lower your rates, right? You take on more of the smaller claims and leave the larger claims to the insurance company. That's perfectly fine, okay? Again, the eligible risks, think of a general store, think of a small restaurant that doesn't serve alcohol. The ineligible, like I said, banks, savings and loans, cinemas, auto repair facilities, and carnivals. The reason I have these on here, and I'm repetitious about me saying it, because this is the stuff I see on the test, okay, that they throw at you. So be aware of those. Those are not eligible for a business owner policy. It is like a homeowner's policy. It's a self-contained package policy. Section 1 is property. Section 2 is liability. At the property, we have coverage A, which is the building itself. Anything bolted, welded, nailed, or attached to that structure would be covered under coverage A. Coverage B is your business personal property. Again, we call it contents coverage. All right. And it covers all your stuff. You know, it covers like your desk, your laptop, your computer, your printer, right? I'm thinking of an office space. If you're a flower shop, it's going to cover your display stands. It's going to cover your inventory, which is your pots, your flowers, your vases, maybe balloons and stuff that you sell also. That can be covered here under coverage B. Under a BOP, it is covered just like commercial property, anywhere in and around the building within 100 feet of the premises. It would be covered there. Liability, right? That's section 2. Liability covers bodily injury and property damage to others. It also has medical expenses to others, right? Remember, medical, anytime you see that on your property policies, it's just covering the ambulance ride. And then the liability covers the lost wages and the medical bills because they're in the hospital and they're not able to work because of the slip and fall on your property. The optional coverages under a business owner policy would be theft. You know, because if you have a small business, you don't do a lot, or maybe it's a service you provide where there's really nothing to steal. I mean, maybe you keep all your tax service and everything you store in the cloud, encrypted in the cloud. And so if someone breaks in and steals your laptop, there's nothing on the laptop. Right? You can just replace it with another laptop. And as long as you have Wi-Fi, you can access the cloud and still continue doing business. That's why it's optional. Some business owners may choose to self-insure, depending on the type of business. Okay. Jewelers, by the way, are a little too expensive for a business owner policy, so that's not something we're going to talk about here. Another optional coverage is boiler and machinery. So let's say you do have a sandwich shop like a Subway. You do have refrigeration equipment to keep the vegetables and the cold cuts cold, and then something happens which causes your refrigeration system to go out. That's what boiler and machinery coverage is all about. Okay. You kind of want to know it as like equipment breakdown coverage, and I guess it would be the equivalent to a home warranty. When you buy a house, they offer you a home warranty, and you pay a fee for it, and then maybe your dishwasher breaks down, you pay a deductible, and someone comes out and fixes that dishwasher. This is kind of, boiler machinery for a business is kind of like the same thing as a home warranty for a house. Okay. But it's optional. You may choose not to take it because you may not have, refrigeration equipment, steam pipes, steam turbines, or anything like that may need that type of coverage. So it's optional. We do have consequential loss coverage, which is the indirect loss coverage, business income. So if you had a little sandwich shop and you had a fire where it was destroyed and you're closed down for them to rebuild, after 72 hours, well, we're going to pay you the lost business income that you would normally earn if you were open for business and working. The business income formula, you can see it down here. It's net income, which on the test, they kind of change it up. They'll say net profit or loss before income taxes, and the expenses include payroll. All right. So this, you need to know the formula. It's net income, not gross income. It's before income taxes, not after income taxes. And the expenses do include payroll, not excludes payroll. So watch the terminology on that. All right. Like I said, sometimes they'll say net profit or loss instead of net income, okay, before income taxes. But again, business income, usually there's a 72-hour deductible. So if a fire does destroy the restaurant, you got to wait 3 days before we start paying you lost revenues. So there's a 72-hour deductible. That's what I kind of call it, okay. Extra expense is another time element coverage, but this one pays immediately at the time of a loss. Maybe you had a daily newspaper, local newspaper. Maybe you're from another country and you get some information from your hometown, home country. Some people feed you some information, and so you create a local newspaper for people with the same ethnic background as you. And then, so you package that stuff up, you put in some local flavor, and then you basically sell it and deliver it to the local community that has subscribed to that. And then your newspaper factory has a fire where you can't get those newspapers printed and out on the street. All right. So time element coverage gives you money immediately to get a location, get equipment, to get up and running as soon as possible after a loss. All right. Now, if you're not able to get up and running within a couple of days, well, then after 72 hours, well, then we're going to pay you the lost business income that you would normally earn if you were still open for business. So this doesn't pay lost revenues. This gives you money to get up and running as soon as possible after loss. And if we can't get you up and running, then you might have the business income coverage, which replaces your revenue because you're shut down due to a covered peril. All right. And that's kind of, there it is. I put it on the wrong screen. This is the side-by-side comparison. All right. Again, Homeowners is a self-contained package. It covers property, theft, and liability. And a business owner policy covers property and liability. Right. So it's a package. It covers two lines of coverage. Theft is optional. Right. And the boiler machinery coverage is optional, sometimes called equipment breakdown. And like I said, boiler machinery is kind of like a home warranty. And a home warranty, I doubt you'll get on your test. All right. But I just want you to know that, a lot of the coverages you have on the personal line side, you've got the same coverages for a business. All right. So if it's a small home, you get that package, property theft and liability bundled up. For a small business, you get the same, similar package, property and liability. You can include theft and boiler machinery, but it's a package for a small business. If it's larger than 2 units, then you go to dwelling, remember 1 to 4, non-owner occupied. If it's larger than the 6 stories, 100,000 square feet, then you go to commercial coverage. That's on the business owner side. But that's kind of how you want to know it. Again, there's a lot of similarities here between these 2 coverages. All right, package for small home, package for small business. Okay. At this point in time, do you guys have any additional questions?
No, I don't have no questions.
All right.
I was gonna ask you. I know the class is being recorded. Are you able to share the class with us?
I will post it on my site.
Okay.
You guys have access to my site, right? You guys are all registered, right?
I'm not sure if I'm registered.
Are you on lgdconsulting.com and studying through my material?
I have not signed into that. I've been looking at. I've been doing the link that shows up that I got emailed to the YouTube ones.
Oh, so you're just using my YouTube videos?
Yes.
Oh, you are missing out.
No.
So if you go to lgdstudy.com, you can purchase registration, use a PayPal link, and then you're going to get an email with the login instructions to study from my website, which has all my webinars, sample test questions, an online playbook of definitions and terms, charts to help you understand the differences in the coverages. It's all dedicated to, I'm not teaching you everything you need to know about insurance. I'm just teaching you this is what you need to know to pass the test.
Okay.
Okay. So you might want to consider that. Okay.
Okay, I know I got registered. Well, I know you got in contact with me because Jody gave you my information. So
So check with Jody, because sometimes she pays for her people to come through my training.
Okay.
And are you taking your test before November 6th?
No, I'm not, and I'm very interested on going to the class that you said you were gonna have as well.
Yeah, it's going to be in Emeryville. So just email me.
Okay.
Okay. Lauren at LGD Consulting.
Okay.
Okay. Email me and I'll give you the information for that class. Okay.
Okay. Thank you.
It's going to be in Emeryville Saturday from 10 to 2. So if you guys are in the Emeryville area and want to come to a live 4-hour cram course with me, it's going to be in Emeryville Saturday, November 6th. Just email me. Again, Lauren at LGD Consulting, or go to lgdconsulting.com and just click to contact us. Send me a message and I can give you the information about that.
Okay, I will. Thank you.
Oh, you got it. All right. Well, if there's no more questions, let's call it a night. Thank you for spending some time with me this Wednesday evening. Good luck in your studying. If you do have questions, don't hesitate to reach out. Okay? I'm here. My job is to help you pass this test and get on with your career. It is a great industry, and this is probably one of the toughest exams to get started in this industry. But once you get this, continuing education is a piece of cake. And with this one license, you now position yourself to be highly marketable because everyone's hiring in this industry. There's no ceiling to the income you could generate with that license. So it gives you unlimited income potential. Okay? So, good luck and keep in touch. Keep me posted. If you have any questions, just reach out.
I will. Thank you. Have a good night.
You got it.
Thank you.
You too.
Thank you, Lauren.
Thank you. You got it. Thank you, sir. Bye-bye.